I think, at the index level, Nifty 50 and BSE 500 are not the true indicators because there is almost a 95-96% correlation between them. I'll just take the example of two funds which were very popular in my earlier avatar at Reliance, Reliance Growth Fund and Reliance Vision Fund. They were very, very well known. Both started at the same time. The NAV of Reliance Growth Fund has grown to 4,000 from 10 in like 31 years. The NAV of Vision Fund is 1,300 in the same time frame. Now, Vision was focused on large cap and growth was focused on mid and small cap. So I don't think it is right to say that the returns have converged. I think the indices taken are very different. The other thing is when you are doing broader market investment, it is not the index. You are looking at companies which can grow faster. And as I said, where, the coverage is not that much and therefore there is some, you can say, differentiation you can add. See, ultimately market price is equal to EPS into P. EPS earning P is perception. When you invest in a broader market company, normally the perception is much lower than an established company. And the EPS growth is faster. And when you have both EPS as well as P growing, you end up making slightly higher returns. Now, India is a country of entrepreneurship. India is also a country of various sectors, upcoming sectors, new sectors. All the so-called large caps at some point of time were startup businesses, including the recent, the Dixons of the world and so many other companies, or Varun Beverages, who started very small and have now become large caps. So I would say that as long as you are entering into a company from a view of obviously some time frame, 3-4 years, faster growing and at the same time trading at discount to the larger bets, I think there is differential return to be made. So we always say this, large caps are like elephant. It is very difficult to topple them, but they will have their own pace of growth. And mid and small cap would be obviously like maybe tigers or some other fast moving animals where there will be more volatility, but when they move, they will move fast. So I think in Indian context, it makes sense to not ignore the broader markets. From an investor perspective, I think investors have to take their call in terms of asset allocation. If you are okay with a longer time frame and willing to bear the volatility, then obviously I think the broader markets will do very well. But if you want stability, you have to have large cap. And if you want both, then maybe a diversified approach or a proper asset allocation is what is needed.